We're here at the Morningstar Investment Conference with Christine Benz, who is head of personal finance for Morningstar. And we're going to talk a little bit about what's going on in the markets right now, Christine. You know, in retrospect, as horrible as it was, it followed a pretty well-rehearsed script. We had a horrible crash and then a severe bounce back. Now, what to do is sort of the question. And yesterday's answer from Steve Romick, a money manager, was a little bit depressing.
It was.
He said, find a rock and hide under it. Are things really that dour? I mean, what is someone to do with their 401k plan in this situation?
Well, I think the typical investor shouldn't get too concerned with what's going on in the macro environment. Again, it comes back to creating a sensible stock bond cash mix given where you are in your life and how close you are to needing that money. So certainly if you are someone who is getting ready to retire or already retired, you want a big share of your portfolio in the safe stuff anyway. But I would say if you have a long time horizon, you do want some stock exposure. You also want some corporate bond exposure, and even though they will incur some volatility in the near term perhaps, I think they'll be a good place to be over the long haul. So stay diversified and mind that stock bond cash mix.
We've seen some disagreement over what to do with government bonds. I mean, generally they've always been considered the safest alternative, but now at very low yields, plus with a lot of debt building up, and we've seen the defaults in other countries, or excuse me, we haven't seen defaults, we've seen fear of default in Greece and Spain. So what do you do with that portion of your portfolio?
I think, you don't want to embrace those all or nothing scenarios. So coming into this year, there was a lot of pessimism over government bonds, and lo and behold, what's one of the best performing asset classes year to date? It's long-term government bonds. So I do think that you need a sleeve of your portfolio in those very high quality bonds, because when you have some sort of flight to quality, say a flash crash type scenario, or maybe something even more prolonged, that part of your portfolio will hold up really well. So I don't think you want to eliminate it entirely, but certainly with the outlook for the deficit and so forth, it's maybe not something that you want to have the whole of your portfolio in either.
Okay, so we know you need stocks, even though they can be scary and volatile. We know you need bonds, whatever happens. Now, there's a lot of talk recently about some alternative investments, whether it's gold, there was farmland mentioned yesterday. So that's kind of tough to get into, but what else should the retirement investor have in his portfolio?
Well, I'm not a big fan of alternative strategies because by and large they can be very costly, and a lot of times what these managers are promising are not huge returns. So if you're paying 1.5%, 2% for a strategy like this and you hope to earn only 6 or 7%, that's an expensive proposition. So one category that's sometimes considered alternative is commodities, and here I would look to a broad basket commodities, maybe exchange traded note, and put a small percentage of the portfolio in it, and the idea is that you're buying some inflation protection, so when your own purchasing power is going down, you'll at least be able to participate in the price increases in some of these products that you need to buy. So I would keep it limited, but I do think that broad basket commodity does make sense.
Great. Thanks very much, Christine.
Thank you.
Thank you for watching.